Hello everyone and welcome back to our next episode of the Property Investment Australia podcast. I'm one of your co-hosts, Lachlan Vidler, and as always, I'm joined by my good friend, Will Sanchez. Will, welcome back, mate. How you been?
Being really good. Really good. Sentiment is up there.
Yeah?
Yeah, the sun is out, so let's do it.
Sun's up. People were listening to our last episode. They were have gotten on board. They're cracking through it. They're ready for more rate cuts and what's to come out of that. Is that the feeling you're getting?
Absolutely.
Yeah?
Yeah, fingers and toes crossed.
Fingers and toes crossed.
Absolutely.
Can you cross your toes? That's pretty impressive.
No. I can try.
But they're metaphorically crossed, aren't they?
Correct.
They're metaphorically
you get the gist.
I get the gist. Well, everyone, we've got I think a really interesting episode today. I think something a little bit different. I mean, I think, and it's different in the sense that I know we haven't really done this before. So today, I really wanted to unpack something, probably a little bit more from my side, but I know Will has his own, things that he's going to want to contribute into this discussion as well. But I thought that today might be a bit of a humbling day for me, and I'd actually talk about the investment lessons that I wish I knew earlier. And that's earlier in the portfolio, that's earlier in life, that's earlier in the personal journey. But the things that I wish I knew earlier, and I mean, we've all been there, right? Like whatever part of life we're talking about, we all always wish that we did something a little bit different or we thought about something a little bit different. But Hindsight, exactly right. And I think that, there's a lot of good quotes out there attributed to really smart people around the fact that, like, if you can learn from others' mistakes so you don't have to make them, that's what the whole point of sharing knowledge and information is. But often we might hear them, but we don't actually change our behaviors and we repeat mistakes that people have said to us. But my hope out of this episode today is just to talk about especially a few of the lessons that I wish I knew earlier, in the hope that, you can see things a little bit differently through my eyes and also hopefully not make some of the mistakes that I have made.
That's nice. That's very kind of you to share that.
Very altruistic of me, right? It's I think it's really important. I think that there's we're all very happy to talk about successes, and success can look different in front of different people. And I mean, let's also be real. People love to sort of hear about things that humanize people and that people aren't perfect and hear about people's mistakes. But I think in this space, it's really important to share those lessons because somebody is always starting out new every single day. And if they can do it better and smarter, that actually makes me really happy for them. And that's what we try to do at Atlas, right? We try to help our clients to do the same thing. But you can't do that unless you have heard some of the lessons, right?
Couldn't agree more.
So, I think for me, just to really start it off, like when I was starting out, probably like most people, I always thought that the most important thing was finding the perfect deal, right? I was absolutely wrong about that for starters.
Perfect.
And you just said it there, perfect, right? You can unpack it so many different ways. But it was definitely not the most important thing. There were lots of important things that happened. And I would say that I probably couldn't even pick one. If I was on a stage in front of a whole group of people, I'd probably pick one to make sure I didn't ruin what was going on the stage. But fortunately, this is our podcast, right? And we can both talk about it how we want. But I don't think that there's any one important thing. But I think that the 4 lessons that I want to talk about today are probably all the most important in their own right, in their own different way. So for me, I definitely made some mistakes. I definitely probably could have made more money. Definitely could have lost less money. But I was also lucky because I had heard lessons from other people and I did avoid certain things. So I guess that's what I want to share today as we go through.
Well, I can't wait. Come on. Wait. Yeah, please get started.
I was going to say, we you and I probably haven't even talked about some of these things before either. So
cool.
Cool.
Different episode. Yeah.
A different episode, right? So I think the first lesson that I want to start with is probably a good scene setter, and it links into what the sentence I said before, or the thing that I said that I always thought about. But I think lesson number one that I would like to pass on and to talk about is buying the perfect property is far less important than just buying the right one. And people are probably thinking, "Oh, what does that mean? Like, what's right? What's perfect? How do you know it's right?" And I think that what I really want to pass on, and I'll tell everyone a story related to it, is that people often associate property with having like the newest property or the best looking property or the cleanest property or the one with the smallest amount of issues or probably more importantly, like with no issues, having it next door to them. Like there's all these things that probably make something perfect in their eyes. And I mean, if we're being really honest, if you could draw on a whiteboard what you want, if the property you own could be next door to you, make you an insane amount of money with no maintenance, and there's always somebody that lives there and it goes up in value, of course that would be the perfect property. But that doesn't exist. But the right one does. And you got to find the right one, right? So the story I want to talk to everybody about is the first property that I almost bought, right? So, and given how much I talk about this, how much we've talked about it on the episode, it's probably going to sound funny to some people. But the first property that I almost bought was actually a house and land package.
Oh, really?
It was.
Oh,
yeah.
wow.
So the story was basically just that I had a very good mate of mine who had started his portfolio, and he had done a house and land package for his first property. And the guy that he was working with had a similar background to me, come out of defense. And I will say, a really nice and I think well-intentioned guy, right? But at that stage of my life, I didn't know too much about property. I was still very green. I was learning, consuming so much knowledge on a daily basis about it because I was just obsessed. But I was still very green in my journey, right? So my mate had kind of struck up a bit of a deal with this guy where any of his mates, of which I was obviously one, any of his mates that he referred across, he'd basically get a cut of the fees that that guy that was going to get from selling the house and land packages, right? And like house and land packages, I mean, still sell, they'll pay like 30, 40 grand. Like we get emails all the time about it, right? People offering us to sell them. And like they're now starting to get up to like 50 grand. So like if we were to go and sell a house and land package to a client,
I'm in the wrong. I'm doing it wrong.
Right?
I'm in the wrong role.
It's insane, right? It's absolutely insane. Anyway, so like my mate, and he's still one of my best mates today, right? There was no issue with him, and there was no issue with the guy, right? At the end of the day, it was my mate who he thought he was helping, right? He thought he was helping. He thought he was going down the right path. He's since changed his investment strategy, and I've helped him acquire some different and some better performing property, right? But he was young as well. He was young and early in his journey. So anyway, the story basically just goes that my mate set me up with this guy. I had a great chat. The guy, like I said, really nice guy. I can't fault him. He genuinely thought, from his point of view, that was the best option to invest in property, doing those house and land packages. Now, obviously, I feel very, very differently about it, and I know about, things that are much better options. But the guy certainly was not like a shady character, right? Mm-hmm. There's a lot of shady characters in that space. This guy was not a shady character, right? We just had a different approach. Anyway, I got so far down the path that I'd seen the property, I'd been through all the documents, all the analysis that was done on it. I'd paid a deposit on it.
Oh, wow.
I had the contract of sale sitting in front of me. And it was at that 11th hour, I just had something going off in the back of my head, and I decided not to proceed with it. In hindsight, I'm very glad, right? My first property ended up being way better. And you know what? In fairness, that probably wouldn't have done too badly, right? Probably wouldn't have done too badly. I think.
Where was it? Do you remember?
It was a Brisbane vicinity house and land package. Yeah, I think it was sort of south of Brisbane. And I mean, I ended up buying up that way anyway. I just ended up buying an established property that's done way better for me.
Logan or there? Around
yeah,
there?
It was like south of Logan type kind of way. Yeah, not my one, the one that the house and land package one. But yeah, ended up in a way better position. Like I think that my first property ended up, it was almost tripled in value. So it was a good result in the end, right?
Absolutely, yeah.
But I almost went. That was almost my first one. And I think linking into the lesson of buying the perfect property is less important than buying the right one. I was originally hooked in because I thought it was the perfect property, right? I was getting sold the dream on all this infrastructure, all this development that was going on. And yes, a lot of it has actually ended up coming to fruition, right? I think that compared to a lot of places, it was probably more good luck than anything else. But I thought it was the perfect property. You know, I was getting sold on the fact it was low maintenance. I was getting sold on the fact it was brand new. I was getting sold on the fact that, you know, like, oh, you're going to have tenants falling over themselves to live there. Depreciation, right? I was getting sold on the fact that not only was this the right property, but it was the perfect property. I would be silly to not do it. It was a corner block as well from memory. Like there was just all these things, right? But what I came to understand at a deeper level, obviously later down the road, was that whilst it looked like the perfect property, it was definitely not the right one. And that was because the fundamentals were very poor, right? Had a very poor land to asset value, right? We're talking about a house that was probably on like 350 square meters or something, or 400 square meters. And the house would have been like the vast majority of that, right? Not much of a backyard. It was in an area of really high supply because we were in a market that was being built. You know, there was nothing but supply. Like it was crazy, right? The vacancy rate was actually a bit higher than what it was kind of represented to me. And it was hard because there wasn't too many properties that were built, so it made it look lower. But the reality was that as more properties came onto the market, the vacancy rate also increased because there was so much supply. And it was like, you know, tenants just had so much choice, right? And that's one of the biggest problems that comes out of those big house and land package developments is that, yeah, when your property gets built, of course, you're the newest, shiniest house, you know, on the block. But 12 months later, there's newer, shinier houses. And it can be really hard to have the rents increase at any rate, let alone a sustainable rate, because there's always something new that can kind of compress it a little bit. And also, like, if your tenants aren't happy with it, or maybe there's been some defects, because we all know the building industry is not really in the best quality at the moment, and it hasn't been for a number of years. You know, if your house is riddled with defects, yeah, you're trying to get them fixed, but like the tenants don't care about that. They're going to move out and they can move like 2 streets over, possibly pay the same price and get the brand new shiny house. So anyway, there were more things that were wrong with it as well. You know, like the numbers probably didn't stack the way I wanted them to. You know, at the end of the day, depreciation is a tax outcome. It's not an investment strategy. Overall, the fundamentals were wrong, you know? And then we fast forward to the property that I did buy in its place, and the fundamentals were right. Already built out, already established, quite a low level of supply. There was good rental income at that point as well. It was really strong rental income. There was a little bit of maintenance, but it was all well and truly understood from things like the building and pest inspection that was completed on the property.
Normal wear and tear.
Just normal wear and tear. It just so happened though that we had a freak incident where one of the sewerage pipes was riddled with tree roots, so I had to get like an excavator into the backyard. It was like
It's happened to us once as well.
Yeah, it was like a 10 grand fix. It was insane, and it was like a couple months after buying. So at the time, I was thinking, "Oh my god, I've bought a lemon here." But it was just one of those things of like, right place, wrong time for buying the property. If I'd have bought the property 6 months later, probably would have paid more money for starters. But that issue probably would have been solved because it happened because of something breaking, right? But like we move on, and in the scheme of things, that 10 grand I think it was about 10 grand, pales in comparison to the money that's been made on it, right? But it was the right property. It certainly didn't look like the perfect property, but it was the right property, and that has ended up being a far better decision.
Now, when you say the fundamentals were there, then that's what it's about, isn't it?
Exactly right.
Yeah.
Exactly right. So, you know, it like something that I think it really links into, and it wasn't so much for my story about that property, but probably just more around like a concept I probably want people to take away from this is that momentum matters more than perfection. And the reason I say that is because I find our clients are pretty good because we're obviously working through the process with them, right? They've got a professional on their side, so we can be there to adjust expectations, to educate them, to do that, right? But it still happens sometimes with our clients. Like, it's not like we're the second coming or anything. Like, at the end of the day, we're people too, and we might not necessarily say the right thing and it doesn't help change somebody's mind. But it definitely happens to people going at it alone, is that you get caught up in perfection and you never end up buying. You end up in a scenario like I was with that house and land package. And who knows, maybe you say no to that one, but then you keep looking and looking and you're still looking at the same thing, but it's never perfect, so you never pull the trigger. Momentum is more important. And momentum, I guess, is attached to that idea of finding the right one, not the perfect one, because momentum allows you to get that. And then 12 months later, if you've done and you actually bought the right one, it then allows you maybe to move into your second one, and so on and so forth. So momentum is so much more valuable than perfection, because if you think about it, my $10,000 excavated backyard problem could have really slowed my momentum down. It could have made me really disheartened, but it didn't, and I was able to keep pushing forward. I was able to keep that momentum and move on to bigger and better things. But if I was just focused on perfection, and I could have been like, nah, you know what, let's sell the house now, or nah, never buying another one. I've got to look for the perfect one now because that one had some issues.
It does
I would
happen.
I would have never captured that momentum to move myself forward, right?
Yeah.
So
Well
that's
done.
my first lesson.
Well done.
Yeah. All right. Lesson number 2, and I think you'll definitely have some thoughts on this one, right? Cash flow isn't just about passive income. It's about staying in the game. So I think this is especially true early on in the portfolio. Of course, as you get towards maybe the back of the middle to the actual back of the portfolio, your strategy is going to change. So I'm probably not talking so much to those people when I talk about this. But most people aren't in that boat, right? We know 91% of people only have 1 or 2 properties, right? So I'm talking to 91% of people, right? Cash flow in the early stages especially, but even up into the well and truly the middle of your portfolio, it's not about trying to make a profit each week or each month or each year from the cash flow, right? Especially in this market, right? Rates are still higher. I mean, you'd see this, right? Like tell me, especially with the rate cuts coming, what's a sharp rate? Like if you're going to like a Combank, like a tier 1, big 4 type lender, what's a sharp rate right now?
5.69.
Yeah. Is that
There's better as well, but
is that variable?
Variable, yeah.
Variable? Is that IO or PNI?
PNI.
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 So is it 5.69?
69, yeah.
5.69. Like that's obviously getting a lot better. I mean, like what 12 months ago we were sitting here,
Well,
we're talking about like almost 7s,
Yeah.
right?
Yeah.
So things are getting a lot better. But the reality
We've got
is
fixed rates close to 5%.
which and we know why, because the banks know what direction it's going. So they're trying to sucker people, right?
Yeah.
That's what I'm talking about by cash flow isn't about monthly profit or weekly profit or annual profit, especially in this market, especially at the early to middle stage of your portfolio, because rates are still elevated compared to where where they've been and where they're trending back to, right? Like I think in our last episode, the rate cuts one, and what that means. I talked about the fact that like I think that over the next 18 months, it could be upwards of a full % of reduction, right? That brings us down in line of like the mid 4s, right? Like that's
How good.
Like yeah, but
How good.
that's when like cash flow can become a little bit more liberal in some circumstances, right? But right now, cash flow is more about the fact it keeps you in the game. It keeps you in the game of being able to continue expanding your portfolio, right? Like even, properties that are like top tier. And what I talk about top tier, I'm not talking about a $10 million property. I'm talking about properties that have the best fundamentals getting around. Reality is you're probably making a small contribution to hold, right? You might be paying, $5K, $8K to kind of hold that property right now. And that's going to get better, especially when you compound that with interest rate reductions and rental increases. However, if you're so focused on the cash flow side, you're going to miss the bigger picture, which is that the performance of the equity growth in that property is going to be way more valuable than you pocketing $5,000 and then paying tax on it, right? but having a decent level of cash flow so that any like contributions you do need to make each year are minimized as much as possible. That's what keeps you in the game, so it doesn't handbrake your lending, right? Like I'm sure you see a lot of scenarios where people are maybe paying upwards of like 20, 30 grand to hold a property per annum.
Oh, yeah, there's heaps. There's all sorts. Like you see people trying to get into the market to buy investment properties around 1.1, 1.2.
Yeah, 1.5.
Like it's 1.5. But but you do see like it's a difficult position for us to say like you shouldn't do this.
Yeah.
Because it's a personal decision. But definitely if you're looking at, increasing your portfolio, there's better alternatives.
There's better alternatives. How do banks tend to receive, like when they see on somebody's like assets and liabilities and their income statements, basically, well, their loan application, which basically functions as like a business income statement and a balance sheet, is how do you, when you have conversations with like the BDMs and things like that, how do they receive seeing somebody like, of course there's an element of relativism, right? Like if you earn $1 million, it's going to be less impactful. But if we're talking about a more average couple, how do banks tend to react when they see somebody that's got like a, 25K out of pocket from a property each year?
It's hit and miss. It depends. It's a personal. It's a case by case. But obviously, if you look at, and that's, I think mortgage brokers tend to avoid showing tax returns when they can, because obviously if you do show that, depending on the type of property, you see so many expenses.
Yeah.
Then if you do have you need to do like a proper assessment, and you've got the tax returns, you got to use the actuals, right? So that's why I try to avoid.
I was gonna
say well, we've got I think we've got a mutual client. She owns a property up. I think it's Airlie Beach.
Oh yeah, I know what you're talking about.
Yeah, she's trying to sell. She's trying to sell.
I remember, you're telling me.
She's trying to sell, but just to hold that property, like it's insane. The property was valued at 600.
Yeah.
It doesn't grow much. It's been like 550, 600 for the last 4 years or whatever.
Yeah.
But just to keep that property, is cash flow she needs is crazy. And she's a savvy woman too.
Yeah. Well, I guess you kind of hit the nail on the head though, right? Like you say it's hit and miss, but you also said you don't show the returns if you don't have to. So I think that says that's the answer, right? Is that you know as a professional in the space, like banks don't respond well to seeing a property with big expenses that are costing the potential borrower of a new property a big chunk of money each year, right? So and the reason why this is a big lesson that I'm talking about is because I know when I started my journey, like a lot of people, my biggest focus was like, I don't want to spend money. Like I just want a house that pays for itself, cracks on, grows $1 million every 5 or 10 years, like literally going back to that whole idea of the perfect one, literally the perfect property, right? Goes up, makes me money each week. I don't have to pay any maintenance. It's easy to do it. Perfect, right? But then by adjusting my expectations and realizing that like realistically, even if I made $8,000 a year, $10,000 a year off the property, when I go pay tax on that, I'm probably left with $7.5K. What am I going to retire on $7.5K? Like, it doesn't really fundamentally change my life, right? And somebody could be like, well, that could be a holiday. And it's like, well, yeah, you know what? It could be. But like, if you can't budget through your normal job to be able to afford a holiday, it's probably a bigger issue at play. Right?
Reality check. Ka-ching.
Yeah. But you know what I mean, right? Like, yeah, of course, $7.5K is still $7.5K. But like, we're not talking about 50 grand. We're not talking about 100 grand each year either. We're talking about $7.5K. And yes, that grows over time, but like inflation also grows and the inflation has bit hard, over the last few years. So I guess my point is that like the big lesson that I learned was I needed to shift my mindset from going, my first property needs to pay me all this money every single week, or it doesn't make sense to invest in it, to if I buy this property and it makes me a couple of K, great, that's nice. But if I have to actually pay a little bit out of pocket, but I also have an asset that's going up like 50 grand a year or something, 10% a year, whatever it is, right? Make up a number. That's a way better scenario than a property that's not growing, but I'm putting 5 or 7.5K in my pocket each year, because one is going to set me up to continue expanding, and the other is going to give me a false sense of financial security, because
maybe that one is for later in life in your portfolio. Then you want cash flow, positive cash flow, maybe.
Exactly right. Exactly. And I think that's why I said, this point especially is for the people to the early mid stage of their portfolio. The cash flow that you get, you shouldn't be thinking about it from the point of view of this is setting me free or anything like that. You should see it as a means to buying more property, because it's doing everything it can to reduce expenses. And if you're still a little bit out of pocket, pretty normal in this current climate. But yeah, that's my second lesson. Cash flow isn't just about passive income. It's about staying in the game. It's about staying in the game. All right. So lesson number 3, there's always a reason not to buy, but rarely is there a reward for waiting. So what do I mean by that? Well, I'm talking more about macro factors here. Okay. So if we're talking about a personal factor, like let's say there's a family illness, or let's say you're paying for a wedding or something like that, of course there would be a reward in waiting, because you're trying to use your money for something else, right? I'm not talking about the 1% type stuff where the money is literally an opportunity cost and it needs to be spent somewhere else. I'm talking to the people especially that are always finding a reason not to buy, especially about something that's outside of their control, right? The economy is not good enough. Rates are too high. Markets have been moving too fast. Oh, I just want to get that next promotion at work. Oh, I just want to do this next holiday, and then I'll knuckle down. Oh, I just want to move house first because I just don't have the time to do it right now. There is always a reason not to buy, but in almost all of those circumstances, there is never going to be a reward in waiting. And I learned that myself, right? I spent an amount of time, far longer than I care to admit, finding the excuses, right?
I think that's a good one.
I'm never going to find a perfect property, right? So
It
right
back to the first
I was going to
one.
say, right smashing into the first one, right? I looked at before I even went down that house and land package opportunity path, I looked at so many properties, right? But then there was always a reason why, I don't think that market's going to do well. It's there's this wrong with it, right? There was always a reason I could find. And you know what? I'm going to just say it. There is always going to be a reason, if you look hard enough, to not buy a property.
Yeah, I've got a client that links straight into that one.
Tell us.
I met with this guy around 11 months ago, and he said he wanted to wait for the rates to come down to do something.
Yep.
Now he's doing something because the rates come down.
Yep.
But he regrets not doing something beforehand because what he now he's chasing his tail.
Yep.
Because the property prices have increased.
Yep.
And now he's going to spend more money to buy that same property he could otherwise have purchased.
Yeah. Yep.
So it's a good segue to that one.
Well, I mean, I've got my own version of that I can share as well. Like, we, as everyone I'm sure would imagine, like we have people who will engage with us in some fashion, and then they might not proceed at that time for whatever reason that is. But then they end up coming back. Maybe it was they went and tried somebody else. Maybe it was they tried to do it themselves. Maybe they just did nothing. They found that reason not to buy. But then they end up coming back, right, and chatting with us, and then working with us. And we had a client earlier this year. It was probably around February, who came back, and I remember personally speaking with this person about 2.5 years ago, and the reason they decided not to proceed was they said, "Oh, the market's too good." Like, they weren't being silly and saying, "Oh, there's gonna be a crash that comes." They're like, "Nah, we're too far at the peak. Like, I just want to wait. I just want to see it flatten off, and then I'll get in once, like some of the heat's out of it, right?" And naturally, I told this client, that's silly. There's no such thing as one market, as I always say, and there's always going to be a new market that's performing, and nothing I said could have changed his mind. Anyway, he came back earlier this year, like I said, I think it was around Feb, and signed on, and he said the same thing. He said, "You know what? I really regret it." And not to be rude to him, but we wanted him to understand the opportunity cost he gave up, more from the point of view of like, we didn't want to have any issues with him down the road of like, we're showing him a property and he's still using that same mindset. Even though he's now taken the leap to work with us, we didn't want him to take the mindset of like, I'm now looking for the perfect property kind of thing. So we actually showed him examples of a number of clients who signed in the same month.
Oh, good perspective.
In the exact same month that we had the meeting with him. And obviously probably a couple months either side as well. And most of them were up on average around 200K, right? When I say most of them were up on average, I mean, everybody was up. We had, I think the lowest that I saw was like 160K in 2 years. The most I saw was like 250. It was around about 200K on average, right? And you can imagine it was a bit of a stab in the heart for him. But like I said, we did it in a productive way, and it was just to make sure he understood. Well. Yeah, exactly right, right? So, but I guess coming to, you know, my story and like why it's a lesson for me is that I found so many reasons. And I could have bought probably a good 9 to 15 months earlier, but I didn't. And I lost out. I lost out on a better sales price that I bought the property for. I then lost out on the growth. You know, it, you know, hypothetically put me back, you know, that little bit further, right? And like, fortunately for me, when I did it, we weren't seeing anywhere near of the, you know, the market booms that we're seeing at the moment, or that we've been seeing over the last few years. Like, there's still markets going, but nothing I was really looking at or could afford. So it didn't impact me, fortunately, too much. But it was a really good lesson because there was definitely some impact. Like, it was probably a, you know, an 8 to 10% impact over that sort of 9 to 15 month time frame, which obviously isn't small, but fortunately it wasn't like what we see now, where somebody could be having a 20, 25% impact in 12 months. Yeah, you know, for me, that was a really real realization. And I think what it was that growth starts before it feels safe. What I mean by that is, you know, we talk about in a lot of episodes, like data lags, you know, like you get good property data from like one of the big research houses or whatever. It could be upwards of 2 months old by the time it gets to you, because of all the time it takes to, you know, have the data actually occur, process it, like all that sort of stuff. So, you know, yeah, growth can often start before it actually feels safe. And when you're looking at markets and trying to judge whether they're going to be high performers or not, of course you can wait, but there is an opportunity cost that comes with that as well. But it often starts before you're actually looking at the data being like, you know what, like data looks great, I'm going to rip in. So I guess the fact of it is that like hesitation will often cost more than actually taking the action. You know, like fortunately, property in Australia is quite forgiving, right? It tends to be quite forgiving.
If you wait the long run.
Exactly right. Like, let's say that you didn't hesitate, but maybe you didn't know what you were doing and maybe you pulled the trigger a bit too quickly. Over the long term, it's probably not going to be too bad, right? It's probably not going to be too big of an impact. But I would say for most people, especially if they are or thinking about using a professional, and you're able to then go through and see their analysis and see everything that's supporting why it's a good idea to do it, that hesitation is going to harm you a lot more than taking the action and maybe being a little bit scared or nervous about like what the result is going to be, right? But it's obviously a really big leap, and I understand that it's easier said than done, but that's why we've got to talk about these things, right? Because by talking about it, it shines a light on what somebody might be too scared to admit to themselves. And I think that's important.
No, it's really good, man. It's really good.
So for me, the final lesson is that the most confident investors are usually the most prepared ones, right? So if we go back to my story of sort of really kind of mucking around for that, what I say, it was about 9 to 15 months. I wasn't prepared. I thought I was. I thought it was easy. I thought property was easy. How I wish I could go back and talk to that version of myself. But I wasn't prepared. You know, I'd never done it before. So I didn't really know the steps of it. I was trying to talk to a few people that knew, but a lot of my mates or like people they might have brought up, like they were helpful, but they weren't at the same time. Didn't really have, family I could talk to about it either. So I was I was very much kind of going at it a bit alone in that respect, right? And I thought I was ready. I thought that really I just needed the cash. I thought, oh, mortgage is fine, like it's all sweet. Yeah, no issue really. I earn money. I earn pretty decent money. I don't really have many expenses, so I'll be right. And it turns out I was so unprepared. It wasn't funny, right? Not only was I unprepared on the research sort of side, so like and being unprepared kind of came from a lack of knowledge for starters, right? Like I could read the back of a property magazine and read like data points, but I didn't really know it or understand it or understand how it fit in. So I didn't have any confidence around where I was looking. So that was probably the first issue. I wasn't prepared in terms of research. And back then, buyer's agents really weren't around, right? Or the few that were, like it wasn't the way it is today. So it was harder in that respect to kind of look at it. I didn't have a pre-approval. So when it came time for the loan and I was in the military and military pay slips looked a lot different, years ago, I had a lot of allowances and things like that. So here I am thinking I'm earning whatever it was that I was earning. It was all good. But the bank wasn't receiving it in the same way. So when I went to go buy the property, that was an issue in and of itself. So I hadn't done the pre-approval. Didn't have a solicitor, so I needed to get help to have the solicitor, and I had no idea about any of it.
Learning as you go.
Right, like literally, like pretty much almost every mistake you can make, or the classic, young pup with overconfidence. That was literally me, right?
Young pup.
That's what it was, right? It was like a young pup with overconfidence. Fortunately, the only thing I really had going for me was I still had a really good streak of decisiveness in me. It was probably the military side. So even though I had mucked around in different forms, when I finally got to the one that I ended up buying, I did act very decisively, right? Like, so that kind of helped. And maybe I was a bit more prepared and things like that. But I wasn't confident because I wasn't prepared, That was it. It was, like to me, confidence really comes from clarity. It doesn't come from guts. It doesn't come from like being a gambler. It comes from clarity. And that's something that I've then brought into the business for Atlas is that like when we work with our clients, they'll get typically like a 50+ page property report. And like, it's not written like a PhD thesis. It's very simple and straightforward, but it's about giving that clarity around all the things that I know they're going to want to see, like due diligence checklists, an analysis on the property, the financial analysis, all that sort of stuff. And it's because I know personally from a lesson that I learned that the confidence comes from clarity. And that's why, like we've run the numbers, literally 96% of clients want us to try and buy the first property that we show them. Doesn't matter if it's the first one they've ever seen. It's because they've got the clarity, so they then have the confidence.
It's a strategy as well.
Exactly right. So, like prepared investors, I think if I was to sum it up, prepared investors know, the role of each property. They know their long-term plan. They know that preparation is going to remove stress from their life because they've got the clarity and they know what's going on. And by doing that, it improves and speeds up decision making, right? And and I guess going back to the example of our clients, that's what we see from them. We'll literally give a client a lot of times because of how hot the market is. We will give them a ring at like 10 o'clock in the morning, send them the property pack. And by 2 or 3 o'clock, they're emailing us back saying, go ahead. So in 5 hours, they're making, a half or $250,000 decision. But it's because they've got the clarity. It's because they're prepared. It's because they're set up. So it speeds up their decision making. They don't have to worry about it being a gamble or feeling like a gamble because they're prepared. Yeah. And it gives them confidence, So I think, in a maybe a business or a literal sense, I guess it's the difference between reacting to something versus leading something.
And when you react, it's always a rush. It's a mad rush. Let's get this done. Let's move fast. And then mistakes happen along the way. Then you're chasing your tail.
For sure. And I know you see that all the time. And at the end of the day, in property, no matter how prepared you are, there is always something that's going to go wrong. But I guess the difference is if you're prepared in every other sense that you can possibly be prepared, it's going to be a lot better to have one thing that's a bit of a spanner in the works than having 5 or 10 things because you had no preparedness. Preparedness. A bit like an American preparedness. Because you have no preparedness, right, for it. And that's, I think, a big key thing, a big key factor. And that's why one of the biggest lessons I took away and I've taken away, in my investing journey, because it's obviously been a journey for me, and also probably my business journey and everything else I've done, that, confidence comes from being prepared, and I'll be the first one to admit, and we're going to wrap up in a minute for everyone listening in, like I am a massive do it later, do it at the last minute. I need the pressure. Uni, I've done a whole bunch of degrees and I did every assignment last minute, every assignment. And it was because
I can relate to that.
You can relate. I needed the stress of like the impending time frame for me to be able to like knuckle down and do the work, right? But as I've gotten older, obviously, got a business that employs a lot of people, my own personal like investing and business journey as well. I've realized that you can't operate like that in the real world, right? I never used a calendar or a diary. I now use my calendar like it's literally like a child to me. Like I have to be around it, on top of it. I have to be, like it is part of me, you know?
Absolutely.
So I think, preparedness also goes into all other parts of life to give you confidence, So I guess outside the property realm as well, right? So
I couldn't agree more with this one.
Yeah, mate.
Really,
what did you
really
think? A bit of me opening up to everyone. What did you think of that? The lessons.
Oh, it's pretty good, man. It's kind of you to share your thoughts, your experience as well. I think that's going to help a lot of people who are facing one of these points that you've raised. They might rethink it and avoid. I think more importantly as well, look for help. Seek for people who can help and shorten the process in the distance as well.
Yeah, and I think that's kind of what I want out of it, right? Like at the end of the day, none of these lessons have come from a theory or a textbook. They're all from real moments, real decisions that I've had to make, real mistakes that I've made. And at the end of the day, if any of them, if somebody can identify with them, I want them to use it, At the end of the day, like, come talk to us if you want the help. That's fine. But I know a lot of people out there want to at least try it on their own, or they have tried it on their own, or they're currently doing it. And if one of these lessons lands, then I just hope that you can take it on board and use it,
Yeah. No, it's funny you should say that because it relates. It really relates to. I had a client the other day and he was talking about the cost of buyer's agents.
Yeah.
And I said to him, it's the way you're thinking about it. Like, firstly, you wouldn't find the properties they find on your normal real estate domain.
Yeah.
So it's your time. So how much does your time cost? So it's an investment, right? So I think it links straight into what you just said.
For sure. Let alone, obviously, the expertise that come with it and wouldn't even know where to look probably if it wasn't for us pointing you in a direction or whatever it might be, So, but look, mate, I'm happy to leave that there. I think I just wanted to share those 4 lessons with everyone. So, if you enjoyed that, please let us know. We talk a lot about property and theory and stuff like that, but we have had feedback from people that'd love to hear a bit more of the personal side. So that was what today was really about. So if you're enjoying listening, give us that feedback. Let us know. We'd love to try and think of more ways we can bring in personal and not just sort of, I guess, professional in a way. But otherwise, please keep dropping those 5-star reviews for us. We love them. There's good comments coming through as well. So we really appreciate seeing them. But otherwise, really the big call to action from today is you've had a couple of good episodes from us recently, around how the rate cuts are impacting things, about lessons learned. So, I think a big key takeaway is professionals are here to help, and I got a great professional that sits opposite me and Will. So if you need help on that finance and that the mortgage front, please go and have a chat with him and the team at Aussie Newtown. Their details are in the episode and the show bio. They're platinum brokers for a reason. So go and utilize them so that you don't ever have to sit and have some of those lessons learned in the way that I have to sit and have lessons learned.
Thank you.
You're very welcome. You are an absolutely exceptional broker, and people need to know that, mate.
Thank you, man.
And then, yeah, for anyone obviously looking at starting or growing their portfolio, come and have a chat with myself and the team at Atlas Property Group. You can get us at atlaspropertygroup.com.au. And we also still have that end of financial year deal running, so get in before it wraps up. And we're looking forward to chatting with you and being able to take those lessons and a lot more lessons to make your journey a lot more seamless and successful. But until next time, thank you for tuning in. We can't wait to be back with you.
This is a Piccolo podcast production.